Okay, let's unpack this. If you're navigating the financial markets, there's this really fundamental line drawn by people like Benjamin Graham, John Bogle.
Yeah, and it's a line you really need to understand.
Absolutely. It's that difference between, genuine investing and, well, something else entirely.
Right. And our sources for this deep dive, they really get into this. We're talking foundational stuff like Graham's security analysis and also Bogle's very practical take in common sense on mutual funds.
They both make it super clear there's a distinction.
A crucial one.
So our mission here really is to use their insights from these key sources and figure out how you can spot true investing. And maybe just as important,
How to avoid the traps.
exactly, how to steer clear of the speculation side. It's about knowing which side of that line you're actually playing on.
So what is investing then, according to these sources? How do they define it?
Well, fundamentally, it seems to be about owning a piece of a business, right? An asset.
Yes, because you've actually analyzed its underlying value. You believe in its long-term potential.
You're focused on what the business does, the actual returns it generates.
Exactly. Things like the dividends, maybe interest payments, or just the earnings growing over time. It's that analytical focus, focusing on the business behind the stock. That's pure Graham.
Okay, that makes sense. It's tied to the reality of the asset. So where does speculation fit in? The sources seem to paint a really different picture there.
Oh, completely different. Speculation, based on what Graham and Bogle write, isn't really focused on the underlying business much at all.
So what drives it then?
It's mostly about forecasting short-term price moves. You're essentially betting on what someone else will pay for it soon.
Like next week or next month?
Yeah, that's driven by market sentiment, whatever narrative is trending. It's not about the company's actual performance or intrinsic value.
Right. Bogle talks a lot about this, doesn't he? How this kind of short-term focus takes over.
He's very critical. He argues this short-term speculation often crowds out genuine long-term investment in the market.
Ah, okay. So the why behind the transaction is key. Is it value or is it just the expected price change? Let's dig into the characteristics then. If investing is long-term value, how should you approach it based on the sources?
Well, investing, as they describe it, it needs that long-term mindset. Simplicity helps too. Patience.
And that focus on valuation you mentioned, getting the price right or at least reasonable.
Precisely. And critically, both sources point towards minimizing costs. Bogle especially hammers this home. True investing, particularly like low-cost indexing, means very little activity.
Less trading, lower costs.
Exactly. You buy, you hold, costs naturally stay low. It's inherent in the approach.
Okay, contrast that with speculation. What are the hallmarks there? And what are the consequences the sources warn about?
Speculation often looks like chasing complicated short-term strategies, maybe trying to time the market.
Or chasing performance that probably isn't sustainable.
Right, an unrealistic pursuit of returns. And the sources are really clear on the fallout. This high activity creates a lot of friction.
You mean costs?
Yes, significant costs. High portfolio transaction fees, excessive turnover, which can have tax implications, trying to jump in and out based on news.
Chasing hot trends or those fun star ratings too.
That's a big one. Bogle targets. Relying on star ratings, which are just backward-looking, often leads people astray.
And how bad are these costs, really? You mentioned Bogle's work.
It's quite eye-opening, actually. His data shows again and again that these costs from high turnover, the commissions, the spreads, the taxes, they act like a massive anchor on your returns.
A drag.
A persistent drag.
Yeah.
Even small percentages, when they compound year after year, decade after decade, they can eat up a huge chunk of your potential growth.
Yeah.
It's what he calls the tyranny of compounding costs.
Wow. And it's not just the explicit costs, is it?
No. The sources also show that strategies like chasing star ratings often result in below-market returns, paradoxically often with above-market risk. Plus, there's the timing issue.
What do you mean?
Investors themselves often lag the performance of the very funds they own because they tend to buy high after good performance and sell low after bad performance. Their own speculative timing hurts them.
Okay, so let's bring this back to the listener. Why does understanding this difference really matter for you trying to manage your own finances?
Well, fundamentally, getting this distinction right helps you avoid some of the most common and, frankly, most expensive mistakes in finance.
By focusing on the long game.
Exactly. Focusing on the actual tangible value of what you're owning and being relentless about keeping those costs down. That's the message from these sources. It's a far more sensible and statistically sound way to build wealth, especially in markets that are always going to be noisy in the short term.
So wrapping up this deep dive then, the core idea we're getting from Graham and Bogle is that real investment. It's rooted in patiently understanding value and recognizing the huge impact of minimizing costs over time.
Right. While speculation is often this high-cost, kind of frantic chase after short-term price changes, a lower probability game, really.
Which leads to a final thought. If market success isn't really found in all that complexity, the constant trading, trying to predict every wiggle.
Could the real secret to successful investing actually be much, much simpler than the financial industry often makes it seem?